I just want, for the video, I want to make it look like I actually spent money. Oh, hey. What up, guys? Welcome back to Flipping Fortunes.
Really quick.
Oh, we'll be back with an intro.
Let's do this.
What up,
guys?
Not this shit. What up, guys? Welcome to Flipping Fortunes. Today we have a super special episode because we are joined by none other than Chase Wild.
Woo! Hooray, hooray.
And this cup is just filled with whiskey. These pussies are drinking strawberry margaritas. So, absolutely, that's what's happening. Chase is the absolute man when it comes to anything mortgage lending, and we have a bunch of questions that we're gonna be asking him because you guys, I'm sure, are super curious what's going on with the market right now, as we all are, and we're gonna dive right into this little man. That was obvious.
We're coming for you, little man.
We're gonna get so deep in this man, it's unreal. Chase, how we doing?
Great, man. How are you doing?
Living life.
Oh yeah.
Living life. So I think the first question that everybody wants to know,
Who the hell are you?
Who the hell are you?
My name's Chase Wild. I've been in the mortgage industry for 11 years now. Been really good friends with these guys for quite some time now, and yeah, just here to help.
We're gonna rapid fire questions at you. You ready for them?
What's going on in the mortgage world right now through your eyes?
From what I'm seeing is that there's not enough homes in the market for how many people want to buy. Right? The cost of lending is really expensive. So for anyone to really qualify for a home right now, it's difficult. So until the amount of homes that come in the market just substantially increase, it's going to be difficult for people to get into homes.
Wouldn't you say a combination of that would be one reason that during COVID in the last couple of years, a lot of people, a lot of big home builders stopped. They just completely stopped building because interest rates were so high. And then another reason is because interest rates were high again, a lot of people have slowed the process of wanting to buy, because selling their property right now and trying to go into a higher interest rate, you can afford less of a house. Well, I mean, would you say that's a couple of the main reasons?
Yeah, I would say a really big reason is because people were able to purchase homes with very low interest rates. So now to buy a new home, they have to sell their low interest rate to now double their payment. A lot of people need to sell their home to utilize their equity as a down payment. So without being able to afford a payment that's going to double, you have to sell your home. It's just it's in a weird spot for a lot of people where they don't want to increase their monthly payments that much.
Well, what's crazy is, like, when you look at like the prices, you're really, like, say you're selling this house, you're really not moving up that much. I feel like, and that payment's doubled.
It's like a lateral move.
Yeah.
Right? Because
So
home values went up by the time they purchased.
Yeah, so I get it. A lot of people are just like in a holding pattern. They're not anxious to sell unless you really have to. And that's why I feel like inventory is still so low, because it's only the people that like really need to sell right now.
For sure, exactly.
So what do you think needs to happen for inventory to go back up?
This is gonna be a dark answer.
Yeah, the real thing is we need to build more homes, especially in Arizona, right? There's just, how many people are moving here?
From California alone I think it's 70,000. Isn't that the number? It's like 70,000 from California every year.
It's a lot, right? And of course, there was a lot of big investors that ended up buying hundreds of doors at times that are now renting them out. There's so many people that are Airbnb-ing in the valley, and with the restriction on the build because of the water situation, there's just so many things that are happening in Arizona where it's tough. And the only way to really fix that is to build more homes.
I completely agree. I think it's either that, build more homes, or there's got to be a correction. And unfortunately, I think prices are going to have to come down, and then I think more people would sell. But we're hoping that latter does not happen.
Yeah.
But would you also agree that because it's an election year, that's also slowed things in general, just because people don't make as many big lifetime decisions right before an election?
That's historically, yes. But also historically, rates always come down during presidential election years.
Right.
So once the election starts ramping up, you might see a little bit of a dip in rates.
This may be a loaded question. Do you think rates are going to drop right before the election?
Yes, I do. I mean, historically, if you looked at whether it's a left president or a right president, the economy always gets boosted to make rates come down, so everyone seems like they have more money before an election, so everything seems great. So if it was the left or the right, it always happens.
Like, if you had to like make an educated guess, are you thinking like a half a point we're talking about a change, as in half percentage point? Are you thinking a full point?
I'm thinking that we won't see a normal market until 2025.
What do you even need to qualify for a mortgage?
Yeah, let's say someone's going for a conventional loan. What is, you as a lender, what are you looking for, and you're telling your clients that they need?
Credit, income, assets. We're looking at FICO score. We're looking at how much you make on a monthly basis and how much you have down for down payment. That's the base borderline what we're looking at.
Cool.
Right? And when it comes to down payment percentage, it fluctuates from the minimum at 3% all the way to a minimum of 5% depending on loan programs. So 3 and 5 is a very normal number for minimum down payments. Unless you're a veteran, then it's obviously 0.
So are those 3 items typically what you need to pre-qual someone?
Exactly.
Okay.
Yep. We're looking at your FICO score, how much you're going to be putting down on a purchase price, and what your debt to income ratio is based on how much you're making on a monthly basis.
If you're going for a conventional loan right now, is it still pretty darn stringent on the 2-year work history in the same field?
That's a good question.
Not necessarily, no. A lot of times you can get around with 12 months. The only thing that they're really stringent if you're self-employed, right? If you're an hourly employee or a salary employee, I can use that income now.
Yeah.
Like, I just need a letter stating that you're starting within 60 days and I can use that income. If you're self-employed, that's when the history is more of a factor. Or if you're like a commission-based, right? If you're selling cars, selling solar, whatever those things are. But if you're hourly salary, very, very easy.
In your opinion, what's the best loan for a first-time home buyer?
I would say an FHA loan is the best first-time home buyer friendly because it has the lowest down payment percentage and it has the most debt to income ratio. So it allows you to have the most buying power for what you can afford.
Yeah. Can you explain debt to income?
Yeah, so typically it's going to be between 50 to 56% as a debt to income ratio depending on the program. And what that means is the mortgage payments, the future mortgage payment, and your current debts have to be less than 50% of what you make.
So we're talking car payment, credit cards,
Student loans, anything that's on your credit report.
OnlyFans.
Exactly.
Subscriptions.
Subscriptions, right.
Which is why I couldn't qualify for a house at first because I had so many OnlyFans subscriptions.
Right, yeah.
Nice.
Yeah, yeah, absolutely. Which one is your favorite guy?
They're all great.
From like a math standpoint, let's say you make 10 grand a month. 50% would be 5,000, right? So let's say your mortgage payment and all your debts have to be less than 5,000 a month.
I think that's the easiest way I've ever heard of it.
Easiest way to explain it.
Okay.
So something that I hear a lot of, this is like an off-the-wall question, but like you'll hear of, once someone's pre-qualified, a lender will like talk with their client and they'll be like, hey,
marry
don't
one,
make...
fuck one, kill one.
Once a lender pre-qualifies their client, they'll be like, hey, don't go make any stupid purchases because people don't know, and they'll go buy like a $60,000 boat and they're like, you just completely screwed your...
So the reason why is because when you're pre-qualified to buy a property, it's based on what your current debt situation is, right? So the most common one is they get a new car, right? So if their car payment's $500 a month, you're pre-qualified based on all your numbers with a $500 a month car payment. If all of a sudden you go out and buy a new car and it's now $900 a month, they weren't accounting for that extra $400 a month that now is getting your pre-qualification over what you're allowed to purchase. So that's a very, very common thing that happens.
And people do that, people do it regularly, like it blows your mind. But
Well, it even goes for like even credit pulls, right? Like if you...
So sometimes, right? Because we're notified if you get your credit pulled during the process, right? So if you're gonna try to buy a car without us knowing, we're notified that your credit's pulled, and it'll say what it was for and if a new line of credit was opened. Right? So you can't really hide it.
So how do you have that conversation? Like, if I tried to hide that from you, what would you say?
You're a fucking idiot. No, I mean, during the very beginning stages, you try to tell them, hey, do not pull your credit. If anything comes up, just tell me what's going to happen. That way we can structure everything around what the new change possibly could be.
Yeah.
It doesn't happen as common as it used to. It used to be very common.
Yeah.
When I bought my first house, I remember we went to set up the internet and Cox did like
credit pull,
a credit pull. And my lender got freaking like pissed. Because it's like, you just got a credit pull on your like record, for lack of a better term.
Yeah.
And I was like, it's fucking Cox. Like, I don't know, I'm just trying to set up internet for like when we move in. So obviously we have the retail side of the business. And one thing that we're running into right now is a lot of buyers, they just got shut down or denied a loan. And they don't really know what the next steps are. And we're trying to help coach them on like, hey, you should work on this over the next 6 months so you're able to buy. What are those items that you would recommend someone that just got denied a loan to work on?
So they're denied one of 3 reasons. Credit, FICO score is too low. Income, they don't make enough or their debts are too high. Or assets, they don't have enough money for the down payment. Those are the 3 main reasons why someone is not qualified for a loan. So depending on what one of those 3 reasons is, that's what you work on. save more, pay off your maybe your credit cards. A lot of people have a high credit card balance. By paying that balance down, you can really jump up your scores as long as you don't have lates or anything like that. One of those 3 reasons is why you're not qualifying.
Yeah, that's one of the most estimated things I feel like is how fast people can improve their credit scores.
I would say most people have a low credit score for the 2 main reasons is late payments or high credit card balances. Right? And unfortunately, with America having the highest credit card debt in history, most people have a high credit card debt, which is making their FICO score low.
Makes sense. So you'd say probably work on getting those credit cards down, get the balances down, and that could probably drastically increase it.
Yeah, because in the mortgage world, everything is tiered when it comes to credit. So 660 to 679 is one tier, 680, 699, 700, 719, so on and so forth. Everything is a tier. Higher the tier, higher the situation.
I've heard that a lot of people will say oh, you can go to a credit repair company. Do you recommend those credit repair companies? Do they work? Because I tried one once because I had a pull on mine that hurt my credit a lot. They weren't able to do anything.
Yeah, so some people may have good experiences. I've never seen a good experience with a credit repair company. Typically what they do, and I can't speak for all of them, but typically what they do is they charge you monthly to rebuild your credit. And what they're doing is they're disputing certain lines on your credit. And when you dispute an item, that now removes that from your FICO score until the dispute is gone. So your score jumps up, looks like they're doing their job, but you can't qualify for a mortgage with disputed credit.
Oh, wow.
So it has to be removed, and then your credit score drops again. So I've never had a good experience with credit repair companies.
It's a little bit scummy. Because I feel like nobody asks the questions like, what are you actually doing?
Yeah.
They just do it.
No, for sure, absolutely.
Yeah. So what would you consider, in your opinion, give me an ideal candidate, credit score wise? I guess income you can't really say because it depends on the house, but what credit are you really looking for?
6'2", 215 pounds, 7% body fat.
Right. Jeff Bezos bank account.
Jeff Bezos bank account.
Well, I pretty much qualify for all of it.
Wow.
Yeah. And
Is that really your score?
yeah.
No, it's not.
Did you just Photoshop that in there? You just Googled.
Welcome, Steven. Your score has gone
Googled the
down.
highest.
It is not 841.
That's my name, big
No,
guy.
the highest that I've heard the highest it can be is 800, so that's what it is.
It can go around. It can be higher. Yes.
Oh,
it could be.
I've
it could be
seen
higher than
bigger,
800.
pal.
Yeah.
841?
As of 6/5/2024.
What are you credit saint to you?
Okay, so do you have?
Really good at paying his bills on time.
You probably have 0 credit card debt, 0.
I have 0 credit card
any
debt. Well, I have
House
$2.5 million worth of house debt.
Oh,
but-
you do?
Yeah.
Do you?
Well, so conventional, anything at 780 or higher is top tier. For FHA, really anything either over 640 is one tier, 660 is another tier, 680 is the highest tier, right? So 680 or higher for FHA is the best you can get. So if you're a 680 or a 750 for FHA, it doesn't really matter. It's gonna be the same.
What about non-FHA?
So really for traditional lending, there's VA, conventional, FHA, and USDA. USDA, there's really nothing in Arizona. Jumbo is another one, and Jumbo 780 as well. So really, they're all going to follow those two.
So a lot of our followers here are, of course, interested in real estate investing, wanting to buy rentals, wanting to build portfolio. What would you say is the best loan program for someone wanting to get into real estate investing?
DSCR loans. DSCR loans, absolutely. And I'm sure you guys know all about DSCR loans, right? How would you guys explain how a DSCR loan works?
They're really nice because you don't have to use your Fannie Freddie. You don't have to have 2 years, 2 years work history. And the biggest thing for Jake and I, because we're typically a little bit behind, is you don't have to have super updated tax returns. So, a lot of times, right, tax returns are huge for you guys. You need to have, the previous year's tax returns so you can know exactly, whatever they made, whatever they had to pay, whatever.
Turns out they need one of the last 5 years tax returns. And
We're typically a little bit behind just because our tax situation is extremely complex and complicated because we have a lot of moving pieces. So DSCR, you don't need any of that. DSCR is debt service coverage ratio. So they basically look at each property you're buying as a business in itself. So when they look at it, they'll say, okay, what is this property going to rent out for? If this property rents out for $3,000, they want to make sure that it's going to be able to cover your mortgage payment on it. And then they're also going to look at your history. So they're going to say, do you have a history of rental properties? Do you have a history of being able to buy these, and do you have a good proof of that you know what you're doing? If you can show that you have a good proof of what you're doing, and you can also show that each business, that your property and business that you're buying is going to cover the payment very, fairly easily, then yeah, then it's not going to be an issue, and they can actually get those knocked out fairly quickly.
My absolute favorite thing about DSCR is, especially as a business owner, you don't have to continue to show more and more and more income because, as Luke said, they're using this property as its own business. So what we were running into before when we were running out of our Fannie Freddie loans was they wanted to see our income continue to climb, which, what does that mean? You have to pay higher taxes. So, of course, as a business owner, you are looking to pay the least amount of taxes you can legally. Of course, that's one of my favorite things is you don't have to continue to show your income going through the roof because they're not looking at just your tax returns.
And that's why Luke and Jake haven't paid taxes in 6 years.
Not true.
It's 7. So if you are looking for a loan in Arizona, this is the man to talk to. We're gonna drop his info down in the video. We hope you took away a lot of information from this.
Thanks for watching the video, guys. Hope you enjoyed it. Like we said, if you need anything mortgage related in Arizona, make sure to hit Chase up. He's the #1 guy here in Arizona and the absolute man. Link's gonna be at the top of that description.
Use this when you close down.
And we'll see you later. Peace.
Yeah!